As the market slows down and interest rates stay elevated, even compared to where they were just 1 year ago, we're seeing more and more people throw around the term, hey, marry the house, date the rate, or sellers and lenders offering mortgage rate buydowns to help you make the home more affordable in this high interest rate environment. But what they're not telling you is how that could negatively impact you down the road. So, as interest rates have gone up, the market has slowed down and the amount of homes on the market in many areas has increased. And what you're hearing, that term, marry the house, date the rate, what people are saying is, well, now you can actually find a house since there's more on the market, but rates are high. So find a house that you like, lock in a rate right now, and in the future, when rates go down, hopefully when rates go down, then you'll be able to just refinance, which is take out a new loan to pay off the old loan. And hopefully that new loan is going to have a lower interest rate, thus making your monthly mortgage payment lower. So, marry the house, find a house you like right now, date the rate, which is lock in your rate for now, even if it's high. And in the future, hopefully rates will be lower and you can refinance, get that new loan to pay off that higher interest rate loan. And you're supposed to be all happy. The other thing that we're seeing right now is that mortgage rate buy down. You might have heard it referred to as a 3-2-1 buy down, or a 2-1 buy down, or just a 1-0 buy down. And the way that that works is the lender or the seller is subsidizing or giving a credit to offset the cost of having a lower mortgage rate on your mortgage for 1, 2, or 3 years. So a 3-2-1 buy down might reduce your mortgage rate on your loan from what would be maybe 6 or 7% now to 3 or 4% only in the first year. And then that rate will go up a little bit for the second year. So maybe it'll be 4 or 5%. And then maybe it'll be 5 or 6% in the third year. The 3-2-1 means it'll keep going up for you over that 3 year period until it gets to what the normal rate is for that loan. So pretty much the seller or the lender has paid some money upfront to lower the interest rate on that mortgage for the first 1, 2, or 3 years. So what happens if you move forward with that with the hopes that rates are going to go down in the future and hopefully you'll be able to refinance? Well, you really want to be comfortable with what the market might do and how that's going to impact your potential to even be able to refinance in the future, even if that's 1, 2, or 3 years from now. Refinancing is taking a new loan to pay down the old loan that you got, the original loan. And so you need to go through and qualify for that loan just like you did the first time around when you bought that house. It takes into consideration the level of equity you have in the home. So when you bought it, the level of equity usually equaled the amount of money you put in as a down payment. So let's look at an example just to see how that would make sense. Let's say today you buy a house for $350,000 and you put down 5%. So you put down $17,500. And let's say that you get a 6.5% interest rate today. And you've heard that rates are high, they'll probably be lower in the future. And you think that you'll be able to get them that rate down to 5.5% by refinancing in the future. So that's a 1% difference. So if your payment at 6.5% would be $2,102 just for your principal and interest, at 5.5%, that your payment is now 11% lower for principal and interest. And that comes out to $1,888. So 11% savings just by going down 1%. So definitely looking at it from that level, to save the $200 a month, that's pretty big. But what happens when home prices fall? If let's say that you're in a market where prices are pulling back and you buy now at this higher rate and hopefully plan to refinance when rates are down, but the value of the home goes down. So in that scenario, when you purchase the $350,000 house, you put down $17,500. That leaves you with a mortgage, a loan amount of $332,500, which is 95%. You're borrowing 95% of what you paid for it. You put the 5% down. So what happens if you buy in a market where prices are going down and you hope to refinance in the future, and hopefully when interest rates are lower? Well, if the price of the home goes down 5%, Your loan amount doesn't change, but you just lost all the money you put in as a down payment. The home is now worth less money. And so if you go to try to get a new loan, a refinance on it, you now have $0 of actual equity in the home, not accounting for whatever you've paid down on your mortgage in that timeline. But in the first year, it's mostly interest anyway. So let's assume that you didn't pay anything down, but the home value went down 5%. So now the home is worth less money, and you go to a lender to try to get a loan, and they look at it and say, well, you don't really have any skin in the game. You put down 5% before, but the home is worth less money now. You still owe what the original loan amount was, 332,500. And if the home is only worth that now, you've got zero equity. And the less skin in the game that you have, the less money, the less value you've got built up in the house, the bigger risk the lender will feel that you are in terms of potentially being willing to walk away from the house should something happen. If the value keeps going down, or if say that you go through a job loss or a job change and you can't make your payments, there's really not much holding you to that house anymore because you've got very little money in it since the home's already lost that much in value. So you may find yourself stuck in that original loan because the lender won't be willing to give you a new loan at that point. And we saw that happen in 2007, 2008, where rates were. Here we could see where rates were in the sixes and came down into the threes, but so did home values. Values were up and they pulled back. And so people that had bought at a higher home value and at a higher rate were stuck with that rate because they couldn't get out of that loan. And the only way to get out of the loan would be to get a new one, but the only way to get a new one would be to put more money out of your pocket down because the home is now worth less money. And so if it's worth 332,500 instead of the 350, now the lender might want you to come up with money, the 5, 10, or 20% for that new loan requirement, whatever the requirement is at that time for that loan. So you married the house and you dated the rate, and then the rates came down, but so did the house value, and now you're stuck. But nobody told you about that. The same goes for the buy down where you probably qualified for the highest payment on that 321 buy down, but you got a teaser interest rate of 3% maybe, or 4% for the first year, and then it goes up for the second year. So remember how we looked at that calculator? Every 1% increase will increase your principal and interest mortgage payment by 11%. Well, if you go from a 3% loan to a 4% loan for the second year in a 321 buy down, the second year your payment's going to be 11% higher, and in the third year it's going to go up 11% again. And so that's going to be quite a different mortgage payment from the initial year to the second or third year. And if you go into that hoping that you'll be able to refinance into a lower rate, if rates are lower at that point, it may be a similar situation where if home values have gone down in the market that you're in, now you may be stuck trying to figure out a way to refinance that loan without having the value in the home anymore to do so. Okay, on the flip side, if home values do keep going up or move sideways from where you buy at, and all of a sudden your financial picture changes. Well, what if you lost your job and had to take a new job making less money? Or if you bought a car since you took the original loan out and you took a car loan on that car, and now all of a sudden your debt to income ratio, or the amount of debt that you have compared to the amount of money that you make, is now too high for that lender to be comfortable with giving you a loan, and you may have pushed yourself out of being able to qualify for a new loan now, and again you're stuck. Okay, so we see some of the reasons why we really want to be careful with this approach if buying a home and hoping for rates to come down. But if they do, and home values in your market do stay or move up from where they are, and now you do have the ability to refinance to a lower rate and a lower payment, you really want to consider what it's going to cost you to do that. If we check out this Rocket Mortgage guide to how much does it cost to refinance a mortgage, they're saying you can expect to pay about 2 to 6% of the loan amount on your mortgage in closing costs. So 1% of the $350,000 would be $3,500. 2%, which is what they're saying would be the low end here, would be $7,000 to refinance. all the way up to 6%. So that's $21,000. So you could potentially be on the hook for between seven and $21,000 on that $350,000 house. Now, again, these are all estimates, but to be able to refinance, and depending on where you are, what state you're in, some states have really high title fees to be able to refinance a loan. And so that's maybe why you're seeing such a big swing there in that 2 to 6%. In some areas, it's not really affordable to refinance because of those added fees that you have to consider. And even if it does make sense because the rate is that much lower, you want to consider how long is it going to take you to break even from all those savings. If you spend $7,000 to refinance and you're saving $200 a month, you got to consider how many months it's going to take you before you've been able to pay back that extra $7,000 that you had to pay to be able to get that loan refinance. And if your savings is $200 a month and you paid $7,000, it's going to take you almost 3 years before you really see a return on that $7,000 you spent to do the refinance. And again, this is the low end of what Rocket Mortgage is saying is that 2%, that 7,000. What if you're at the higher end? It could potentially be 6 to 10 years before you actually break even on the cost that you had to spend to refinance that loan. So again, you might be stuck there longer with that mortgage than you initially thought, so because it might not be worthwhile financially for you to be able to get that mortgage at that lower interest rate. So hopefully that helps you see that there's a lot more to consider when buying a house now and hoping to refinance later, and how you could potentially be stuck with the loan that you get now if things don't go exactly as planned. If you found this helpful, please hit that like button so I know to make more content like this, and hit that subscribe button to be notified of new videos as I put them up. If you have thoughts or questions, drop them in the comment section below. If you're considering making a move but not sure how it'll impact you in the market that you're in, feel free to reach out. My contact info is in the notes, and I'm happy to connect you with an agent in your local market to help you understand exactly how that's going to impact you and whether it makes sense for you to buy now or wait. Thanks for watching, and see you in the next video.